Have you ever pondered over how corporations manage to secure funds rapidly without going to a bank? Similar to how you might borrow $1 from a friend, assuring them you'll return it the next day, businesses have their own version of this. It's known as a commercial paper. Allow me to illustrate this concept. Picture yourself at a lemonade stand, needing $1 to purchase a refreshing cup of lemonade. A friend offers to lend you the dollar with your promise to repay them the next day. That's almost the working principle of commercial paper in the world of finance. They are short-term, unsecured promissory notes issued by corporations, a sophisticated manner of stating their IOUs from one corporation to another. Now let's delve a little deeper. Commercial papers are typically issued for the funding of payroll, accounts payable, inventories, and meeting other short-term liabilities. The maturity period of these papers is usually up to 270 days. The fact that they are unsecured means there is no collateral behind them. If the company fails to pay, the investor has no claim to any specific company assets. But why would companies use commercial paper? Because it provides a more efficient and less costly method to obtain financing compared to bank loans. The interest rates on commercial paper are usually lower than bank loan rates. It's also a more flexible method of financing because the company can decide the amount and the timing of issue. Therefore, instead of requesting a bank for a loan, a company can issue commercial papers to raise quick funds for short-term needs. So, commercial papers function as quick loans for corporations in need of cash urgently. Consider it a corporate equivalent of your friend lending you that $1 for a lemonade. But why do companies resort to using these commercial papers? You might be wondering. Let's dive deep into this. Companies are actors in an economic theater where cash holds the royal scepter, and at times, they require it immediately. The reasons could be multifaceted. They may need to acquire inventory to match up with the rising demand, compensate their workers, or capitalize on a golden business venture that has presented itself. Relying on conventional bank loans might cause them to lose these time-sensitive opportunities. So, they opt for commercial papers. Now, let's understand this process more meticulously. A company, when in desperate need of funds, formulates these legally binding promises to repay, also known as IOUs, termed commercially as commercial papers. This can be visualized as company making a public announcement: "Dear investors, lend us some capital and we'll repay you with a bit of extra." Investors who are always on the lookout for profitable ventures procure these commercial papers. This transaction is essentially a loan, where investors are lending their money to the company. In return, they're guaranteed their original investment with a small added amount. This is the interest. This seemingly simple process creates a win-win situation, with companies procuring immediate cash and investors earning a bonus over their original investment. In essence, commercial papers offer companies a quick, efficient, and less bureaucratic method of securing funds, without the need to collateralize assets or go through a lengthy approval process. On the other, it provides investors with a short-term investment option that can potentially offer better returns than other safe assets. So both parties greatly benefit from this arrangement. Commercial papers, an intriguing financial tool, comes with its distinct benefits and risks for both companies and investors. Let's delve into understanding its dual aspects. For companies, issuing commercial papers can serve as a swift and straightforward method to raise necessary funds. Route of short-term financing doesn't require collateral, which adds to its appeal. On the other hand, investors find commercial papers to be an attractive opportunity to yield returns on their investments, often exceeding those from traditional savings accounts. However, every rose has its thorn, and so does the case of commercial papers. Should the companies take a turn for the worse, it's possible that they might default on their obligations, causing a substantial risk for investors. This could result in the depreciation of your investment, or in the worst-case scenario, a total loss. Therefore, while commercial papers are indeed an enticing prospect, they are accompanied by inevitable risks and rewards, much like any other form of investment. Let's delve into how commercial papers differ from traditional bank loans. Traditional loans typically demand collateral. These are assets pledged by the borrower to secure the loan. Should the borrower fail to repay, these assets can be seized by the lender. In contrast, commercial papers operate differently. They don't demand any collateral. View them as short-term, unsecured loans that are issued purely on the borrower's credit worthiness. It's a game of trust, where companies pledge to repay and investors place their faith in them. Hence, the fundamental distinguishing factor here is the need for collateral in traditional loans versus its absence in commercial papers, and the dynamics of trust that commercial papers heavily rely upon. In essence, commercial papers are unofficial promissory notes from companies to investors, providing a swift financial solution for immediate cash needs without requiring collateral. Unlike traditional loans, investors purchase these papers directly, giving a monetary boost to the company. In reciprocation, they receive not only their initial investment back, but also additional profit. This is known as interest. However, commercial papers aren't devoid of risk. The company falls into hard times. The investor could potentially lose their investment. So commercial papers signify a unique blend of investment, risk, and reward, differing from conventional loans and adding a touch of financial wizardry to the business domain.